I've been preparing my clients for the much talked about Federal Reserve rate cut directly impacting mortgage rate cuts in mid-September. This week's big news was the announcement by the Fed chairman that he may want to have a larger rate cut, a half a point versus a quarter point, given the soft jobs report that came out on Friday, reporting 142,000 jobs added in August, below the forecasted 164,000. Why do we care about the jobs numbers or inflation if we want to buy a house? Because mortgage rates are indirectly tied to these factors. Rates trend up or down given what investors are doing, and the real estate market is a predictor of how well the economy is doing overall. That's why in 2022 and 2023, the Feds increased the federal borrowing funds rate to slow economic growth and get inflation under control. This was most evident in the skyrocketing cost of housing. Inflation was above the Fed's target 2%, so the Feds began raising rates, going from a whopping low of 2.5% up to 8% in less than a year and a half. This literally slammed on the brakes for home buyers who were priced out of the market with the doubling of home prices and the spike in home loan interest rates. Much like the spring home market is for sellers, this fall may be the equivalent for buyers, as inflation has slowed and the economy is cooling. Mortgage rates change based on investors' view of how the broader U.S. economy is doing, which is tied to the demand for mortgage-backed securities and the federal government's policies affecting the market. As the weather begins to cool, so is the U.S. economy, along with a slowdown in inflation. The Fed is expected to start lowering the federal funds rate soon, so don't be left out in the cold and miss out. Buyers who are prepared will position themselves at the right place at the right time.